We had a bear channel yesterday. I always think of a bear channel as a bull flag because 75% of the time you get a break above the channel. We're opening in the middle of yesterday's range. These prices are all wrong. TradeStation and the Merck have not yet fixed the rollover prices. So all the prices on the daily chart, everything is wrong. And they might be waiting for June to come off the board next week to fix the prices. So for example, this high right here, the all-time high, is 3371.90. And it cannot be 90 because every tick is 25 cents. 90 is not a multiple of 25. So every one of these prices is wrong. And I'll fix them once they adjust it. These lines are wrong. They're based on the June contract, which is now not the front, no longer the front month. So, but they're approximate. I'll leave them there for the time being. This is the Globex chart. We're near the Globex high. Well, I'm having a hard time. In the Globex chart, we have a bull channel. Yesterday, bear channel, bull flag, expect a bull breakout. Bear channel, a bull channel, bear flag, expect a bear breakout. So we'll probably get some kind of a sell-off early on. It's possible that we just keep going up and up and up and totally erase yesterday. But I suspect more likely today is going to be an inside day. Yesterday's low is probably too far down for the E-mini to get there today, and yesterday's high is probably too far up. On the daily chart, we're right around the 20-day moving average. There was support, support, resistance, support, 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 and possibly support. We still have an island top here, and we're still in a small pullback bull trend. Even though yesterday was huge, I want to say what I've said several times, it's a 3-day pullback. And every pullback since March has been 3 days or less. So the bulls are hoping that this is just a pullback to the 200-day moving average, which would be right there. Let me change the color of that. Both the 200 and 50-day moving averages are relatively close. We've been sideways now for a month. Big up, big down. The bears really needed today to be a second consecutive bear day if we were going to collapse down. I did not think we were going to collapse. I thought that this was a bull leg in a trading range. This is a bear leg in a trading range. This was a buy climax. And very often, if you get a reversal down from the buy climax, you have to go sideways for several days. The bulls will try to get a micro double bottom, and then they'll want the bull trend to resume. And the bears will try to get a lower high and a second leg down. With yesterday as big as it was, I think we'll probably get a second leg down. So I think it'll probably be like this, a small version of this. Big sell-off here 4 days, here just a couple days, and a bounce for several days, and then a second leg down. I do not think we'll do that. But I still think the bears have a decent chance of coming down here. We're back above a 10% correction, so we're no longer in correction territory. We're back above the 20-day moving average, and we're holding support of the 200-day moving average. So as bearish as yesterday was, it's not all that bearish. If we were to gap up on Monday, we would have a 2-day island bottom. When the market's in a trading range, island tops and bottoms are fairly common, and they're typically minor reversals. This one has the potential to be a major one because it's coming in a buy climax, and we have a double top with the February high. Well, more likely, it's not going to lead to a bear trend. It might lead to a trading range, make sell off down to here, but I doubt that it's going down there. Weekly chart. We have an upside down week last week. Today's Friday, so weekly support and resistance are important. The bears would like the week to close below last week's low. But with the size of today's gap up, I think that probably will not happen. First part of the day, a bear body, but a big tail below. So traders are not eager to sell below 1. And for the bulls, they're viewing this as a bull trend. and 1 as a pullback. It sold off down to the close of 1, but traders do not want to buy above the big bear bar this far above the average price. Most of the time, when you get a big gap up, you're going to get some kind of an early trading range. Just like yesterday, we had a big gap down, and we were sideways for over an hour. Usually the market has to get closer to the moving average, and then it decides whether to go up or down. A big gap down, if you're going to get a trend, it's more likely to be down, but not much more likely. And today we have a big gap up. If we're going to get a trend, it's more likely to be up. We have the 60-minute moving average, magnet above. We have yesterday's high, magnet above. We're not that far from yesterday's high. What do you do right here? You wait. You don't want to be buying above the big bear bar because you're paying far above the average price, and you don't want to buy a big bear bar that's not far above average bullishness. And as for selling below 1, we have a tail. That means it went down and there were buyers. So not good to sell below 1. Probably a trading range open, probably more limit order trading. Sellers above, buyers below. According to this, the low of last week is 3016.40. And remember, it cannot be 0.40 because every tick is 25 cents, so it has to be a multiple of 25. And that's why I have approximate. These are all approximate prices because they have not yet back adjusted the daily, weekly, and monthly charts. Bulls hoping that this is a pullback and that 2 is a high 1. So this is a bull trend. The gap up is a bull trend. And they're hoping 1 is a pullback and that 2 is a high 1 buy signal bar. But after a bear bar 1, I think it's not worth buying above 2. What happens if we get a bear inside bar closing on its low? If it closes on its low or near its low, it would be a credible sell. But you have to assume we're probably in a trading range open. Bar 1 is a trading range bar. It went down, it went up, and closed in the middle. In general, whenever you have big down, big up, you get big confusion. The bears are concerned that it's not as bearish as they want. The bulls are concerned that we sold off big yesterday, we might sell off again today. So you get confusion, and if traders are confused, they typically are not willing to hold on to trades. They tend to take quick profits. And also, they don't want to buy too high, like far above the moving average. They want to buy low, and they don't want to sell too low, and therefore they want to sell rallies. So you got traders looking to buy low, sell high, and take quick profits, and the result is typically a trading range. 60-minute chart getting near yesterday's high and the 60-minute moving average. Bulls are hoping that this is just a sell vacuum test of support. Support is the 200-day moving average right there. Can you sell the 1 high? It's probably okay, but where's your stop, right? Is your stop above yesterday's high? Is your stop up here? The bars are big, so the risk is big, and trading with limit orders, I'd wait for the market to go sideways for a few bars before thinking about trading with limit orders. And as I said, I'm not willing to buy this far above the average price when we have a bear body on 1. So right now I'm trapped out. Sometimes you'll get a very big bear bar in a bull trend, and it's just a bear trap like this, like that. And sometimes in a bear trend, you'll get a very big bull bar, and it's a bull trap like this. So a big bull bar and the bear trend continue down. And big bear bar, maybe the bull trend continues up. We don't know. As I said, it's a 3-day pullback, and we've had a couple other 3-day pullbacks, but we have not had a 4-day pullback. So it would be interesting to see over the next few days if we get a low below today's low. That would be a 4-day pullback, and that would be the first one in the 3-month bull trend. Pair of consecutive bull bars with decent-sized bodies. So 3 closes up here. That would be always in long, and it would be reasonably good for the bulls, right? So that increases the chances that we can get a bull trend from the open. The problem the bulls have is, look how far down the moving average is. A lot of the bulls do not want to buy that far above the moving average. Sometimes you'll get bull trends from the open where you have a bear bar and a couple bull bars, but it would be very rare for the market to begin going up this far above the moving average. So this is probably not going to go very far. Here are some examples of days where we had a gap up in a bull trend. So we gapped up far above the moving average, and it became a huge bull trend. That is rare. Again, gapping up far above the moving average. Today, we're gapping up far above the moving average, but that's rare. More often, you have to get closer to the moving average before you get a big bull trend. This is closer to the average than we are today. Here, the moving average is right there. If I carried the moving average down, it would be right around that low. So if you're going to get a bull trend from the open, you'll get a couple days a year that are like this, a couple days a year like that, and we'll get a couple days a year like yesterday on the bear side. They're rare days. You can see hesitation. We get that tail up there. Traders don't want to pay that much above the average price. Can you sell below 3? A gap up and a buy climax? If it becomes a big bear bar closing on its low, it would be a credible sell. We still have a minute left, so it's possible. Do I think it's likely? No. I think, like I said, most of the time you're going to get some kind of a trading range open when you have a big gap. Bulls trying to get consecutive bull bars closing near or on their highs, but we're spending a lot of time below the high, so this is probably not going to close on the high. It's probably going to disappoint the bulls. Bulls trying, but even if it does close on the high, I'm not going to buy up there. It's just too far. You don't even see the average price. We're so far above it. Okay, there. It closed in the upper third, but not on the high. So to me, we're not going to go up much from here. So if I were a computer, I possibly would be selling here and selling more higher. As an individual trader, I don't want to. If you're a computer, you can sell. Let's say you're a computer with $100 million account. You can sell one E-mini, sell another one 2 points higher, another one 2 more points higher, and keep doing it up 30, 40 points, and you'll have a total of 30 or 40 contracts. And if you have a $100 million account, that's nothing at all. But as an individual trader, I don't want to be thinking about scaling in, 30 times. I don't want to be scaling in 4 times, 3 times. I don't want to be scaling in. But if I were trading it, I would trade it like a computer and just scale in as it goes up, betting that it's not going to become a bull trend. As an individual trader, best price to wait. Can you sell below 3? A buy climax. Now, if you're selling, especially after a big gap up, it's better to sell below a bear bar. Bears are hoping that it's going to be a gap up and a buy climax, and then they're hoping that we'll put in an early high of the day. By a buy climax, I mean it just goes up and then down. So up and down. If it goes up twice, then you get a low 2, which is also a common pattern. But if it reverses down the very first time, I just call it a buy climax. If there are 2 legs up and reverse, then I call it a low 2. So strong rally, 2 reversals down, 1, 2. So you could call this a buy climax sell, but a bull body and a whole bunch of bull bodies. So I would not take the first reversal down. However, if we get a second reversal down with a bear bar closing near its low, it's a credible sell. Big gap up, low 1 here, and then low 2 there. Big gap up, immediate reversal, no low 2. So it's just a buy climax and a reversal. Buy climax, reversal. Here we go. This is really a low 2, low 1, low 2. So it's a biclimax and a second biclimax. Again, low 2, low 1, low 2. But I also have it here in the biclimax category because it's a biclimax and you have a second signal. But it is a low 2, low 1, low 2. Biclimax, low 1, but a bull bar, not a great sell. A lower high, but after a pretty good bull bar. And then you got a trading range, double bottom, double top. And double top, not a good sell signal bar, not a good sell signal bar. Then we start to get bear bars closing on their lows. Traders will start selling there. So what happened to those bulls that bought above 2? Most of those bulls were computers just looking for a trade up. Most individual traders know that it would be dumb to buy above 2, far above the moving average after a bear bar 1. Now we have consecutive bull bars. We have a big gap up where we was in 1. Can you buy the 3 low? Look at the average price. It's still way down here. So I would not be too quick to buy. Huge bear bar. What about selling below its low? There are probably buyers below 3, so we're probably going up to the 3 low. So it's a bad sell signal bar. And even though we're far above the average price and it's a biclimax, it's a bad sell signal bar. So chances are there'll be buyers below 3, and therefore I don't want to sell the close of 4 or below 4 because we're probably going up to that 3 low. Not necessarily on bar 5, but probably before we go down very far. Can you sell below 4 and put a stop above 3 and just hope that we fall for a measured move? I'm not going to do it. The math is probably okay, but you're risking 15 points early in the day. And if you get, sometimes what happens is you get really big bars, really big moves early in the day, and the stops are far away. And you take a trade, and you get stopped out. And here you lose 15 points. And then all of a sudden, the bars start to get small, and the market starts to go sideways. And you think, darn, all I can make is 1 or 2 point scalps for the rest of the day. I'll never make back my 15-point loss from the first hour. So that's another reason to be pretty selective if you're going to be taking trades in the first hour that require very wide stops. We know today's probably going to spend a lot of time sideways, right? Because big down, big up creates big confusion, and it usually results in the market going sideways. So today's probably going to be sideways. We have a moving average there. We have a moving average here. So we're sandwiched between 2 moving averages and in the middle of yesterday's range. And we have big down, big up. So you have to assume we'll be sideways for a lot of bars today. So losing 15 points in the first hour, I think it's a bad thing to do. Now for the bulls, they have a high 1. A gap up is a bull trend. We have more bull trend here and a pullback to a high 1. But 4 is a bear surprise bar, so we're probably going to get a second leg sideways to down. And the reason 5 is rallying is because traders expect the market to get above the 3 low, right? It was reasonable for bulls to buy the 3 low and buy more, 2 points, 5 points, 10 points lower, expecting that it'll come back above the 3 low before it goes down very far. And so you get buy the low bulls 3, and they buy more lower, 5 points, 10 points lower. And they might buy the close of 4, trying to get it back above the 3 low. They want to get 1 tick above the 3 low where they can take profits on their first entry and then get a profit on their, they get out break even on their first buy at that 3 low and a profit on this buy. It's important, I think, to be patient on the open. Everybody is eager to trade, but, the goal has to be to make money. And if it's difficult to structure a profitable trade for any reason, bad signal bars too big, risk too big, things are unclear, limit order market, so it's better to trade with limit orders than stop orders. If there are things going on that make it difficult to structure trades, then it's better just to wait. Consecutive bear bars on the open, one with a big body closing on its low 4. So we're probably always in short, but it's a trading range open, and that makes the math not all that good for selling at the low. For the bulls, double bottom 1. Trading range opens often have both double tops and double bottoms. Yesterday was an example. We had a higher low double bottom, and we had a higher high double top. We had 3 bull bars, yet that was the top. We were in a triangle, a bear breakout, and a pullback, and then we got a couple bear bars. For the bulls, double bottom 6. They view this as a high one, so a bull trend and a pullback. Do I still think we'll get above the 3 low? Probably. Is it a possible low of the day? It's possible, but of the first 5 bars, 3 are bear bars with decent sized bodies, and we're far above the average price. So I'm not going to be buying above 6. I don't want to pay above average for bars that are not above average bullishness. Can you sell the 6 high betting on a failed rally, betting on a bull trap? I would not sell above a bull bar in the bottom half of what is probably a trading range open. So the math right here is not very good. I think we're always in short. We triggered the short by going below 5, but it's probably going to be a trading range open. And typically, by the time the market is clearly short, it's going to reverse up. And by the time it's clearly bullish, like bar 3, it's going to reverse down. Trading ranges, you bet on reversals, you don't bet on breakouts. And at some point, you get a breakout. But right now, better to wait for more information. We should get up to the 3 low, because it was reasonable for limit order bulls to buy the 3 low and buy more lower. Some buy the 3 low, and then they wait for a bull bar 6 and buy more above 6. So they buy there, and they buy more here, and that's their average price. And if they're very disappointed by 4 or 5, they'll get out average. So they'll get out at that midpoint. So sometimes it will not get to the 3 low. It'll just get to the average price, the midpoint between the 2 logical buys, the 3 low and the 6 high. Okay, just did. Now it's up near the 3 low. What happens if it hits the 3 low, does not go above? Then the bulls above the 3 low will be quick to get out. Sometimes when you get a huge day like yesterday, and then the next day, today, opens in the middle of the range, you get a small trading range day that just stays right around the middle of the range. Here's an example, big bear day, and then a doji bar, a big bull day, and then a doji bar, right around the middle of the range. Here's an example, big bear day, and then a doji bar, a big bull day, and then a doji bar. Back above the 3 low, so limit order bulls made money. Bulls are hoping double bottom 1, 6, and that 6 is the low of the day. They're hoping 4 or 5 is just a bear trap. Remember, trading range opens, assuming this is going to be a trading range open, you typically get both a double top and a double bottom. We have the double bottom, and bears will try to get a double top. When you have a big gap up, most of the time you get some kind of a trading range, and the bulls will try to get a double bottom or a wedge bottom near the moving average. This is not near the moving average. So we probably have to get closer to the average price before we can go a lot higher. Big gap up, bulls want to buy, but they want to buy closer to the average price. Here we dipped below the moving average. Here we got close to it. So a double bottom or wedge bottom near the bull, near the average price. They want to rally. And the bears are looking to sell. They want either a double top or a wedge rally, and they'll sell hoping to get a swing down. So you can see what happened at the 3 low, a lot of sellers. Who were the sellers? Well, some of the sellers were bulls who bought the 3 low and bought more lower. Others were bears knowing bulls would take profits there, expecting a trading range open. So some bears had limit orders to sell the 3 low and looking for a 2-point, 4-point, 5-point scalp. So if you're a bull, hoping this is the low of the day, you're concerned 6 had a tail on top, 7 has a tail on top, and there were 2 big bear bars. Bears are hoping that this is a lower high and that we've begun a bear channel. Can you sell below 7, sell below 8? I would not sell below 7. We have consecutive bull bars, and it's at the bottom of a developing trading range. If 8 is a bear inside bar closing on its low, you could argue a lower high double top or a low 2, a second failed breakout above yesterday's bear channel. But the bears would need a reasonably good sell signal bar 8 to attract sellers. Trading range open, bears want to sell, but they don't want to be selling near the bottom. They want to sell a reversal down near the top. Bulls want to buy, and this is a reversal up near the bottom, but it's also far above the average price, and therefore it's probably a minor reversal, a leg in their trading range, and not the start of the bull trend. What happens if 8 closes on its low? Can you sell that? A lower high? It's still pretty low in the range for selling, and it's after 2 bull bars. So that makes it less good. 15-minute Globex chart. We went above the Globex high, and now we have an inside bar and a second inside bar. So an II pattern. Usually it's a triangle on a smaller time frame chart. The bulls hope it's a bull flag and that we go higher. The bears hope that it's a micro double top and that we reverse down. Wedge 1 or 1, 2, 3, top of a bull channel. Breakout mode. Now, is it a triangle yet? Not necessarily on the 5-minute chart, but we have 1 low, a second low, and the tail on the bottom of 8 is a 3rd low. So in some smaller time frame chart, it's probably a triangle. It's a 2-minute chart. So we have a low, a higher low, and a higher low. There's a 1-minute chart. We have a low, a higher low, and a higher low. And we have a lower high and another lower high. So it's a triangle. On the 15-minute chart, we have an II, and that's almost always going to be a triangle on some smaller time frame chart. And you can see on the 1-minute chart, it's a triangle. So breakout mode. Does not look like a triangle on the 5-minute chart, but the 5-minute chart is also breakout mode. We have a double bottom and a double top. Now, what about selling below 8 if it closes near its low? Like that. It's a better sell than below 3, but it's selling fairly low in the range. And that always makes me suspicious whenever there's a trading range open and a decent sell signal, but it's in the bottom half of the range. I think the probability is less, so I usually do not take that sell. I wait to see if we get 2 or 3 bear bars and then think about selling. So this is a possible high of the day. So I did not take it, but I'm not. It's not dumb to take it. It's okay to take it. I'm just going to wait to see if we get follow through. I don't like selling too low in a trading range open. You can see the hesitation. That means a lot of traders are looking at it, thinking that maybe it's a short. You have some sell the closed bears 5, disappointed 6, 7, and they sold higher, expecting it to come down to the 5 low, and that's where we are now. So a lot of those bears will buy back their shorts. We don't know if a lot will buy back their shorts or if they'll hold and take a chance that 8 is the start of a bear trend. We'll know when we see 9. If it has a fairly big tail below, that means that a lot of the bears who sold the 5 close decided to just get out, break even, now that it's back to the 5 close. It's back to the 5 close. Potential for the bears to give up here. So if the bears who did sell the 5 close decide not to buy back their shorts, other bears will be encouraged, and it could lead to a quick breakout. Breaking out, new low of the day, good for the bears. Will it close on its low? Will it close below 1? Will 10 also be a bear bar? Will we get follow through selling? Or will the bulls get a reversal, a high 2, 6? Good pair of bars for the bears. Will bulls buy above 10, high 2, 6? It's a big enough bear surprise so that the bulls would be in a very good bull bar, 10, to attract buyers. So right now it's more likely that we'll go at least a little bit lower. Possibly a measure move down based upon the height of the range. Maybe a measure move down based upon a lower high double top. Bears want to get another bear bar that would increase the chances of this going lower. And bulls want to get as good a bull bar as they can get, hoping that it'll be a high 2, 6. Right now it's more bearish than bullish. So more traders selling than buying. For the bulls to buy above 6, you can call it a high 2, high 1, high 2. You can call it a wedge. We went down on 2, up on 2, and then down on 6, up on 6, and then down on 9. Bulls are trying to get back to the open of the hour. We're getting late in the hour. And right now, the 60-minute bar is a bear bar, closing near its low. And the bulls, they don't want it to be a bear bar, but they certainly don't want it to be a big bear bar. So they'll try to get back to the open of the hour over the next 3 bars. Whenever you see bad follow through, you're always going to be thinking trading range. A pair of big bull bars and then reverse down. So bad follow through. A pair of big bear bars, 4, 5, reversal up. A big bear breakout, 9, and bouncing. So this is trading range behavior, and it lowers the probability that we're going to get a big trend out of this. Some limit order bulls bought the 6 low, some bought the 1 low. The ones who bought the 1 low and bought more, 2 points lower, 4 points lower, have made money. So limit order bulls made money. And the ones who bought the 6 low, it has to get back above that 6 low for them to make money, which it just did. And so here we have bulls buying in a bear trend and making money. So there's something wrong with the bear trend. And while it is a bear trend, we have lower high, we have a lower low. It's probably not going to be a big bear trend day. If it's easy for bulls to make money in a bear trend, then the bear trend is usually not very strong. Fighting over the appearance of the bar. Remember, 9 breakout, new low of the day. The bears wanted consecutive big bear bars closing on their lows. Instead, they got a bull body, 10. So weak follow through selling, and it creates hesitation. Traders are wondering, is this a bear leg in a developing trading range? Is it a high 2 bottom, 6 and 10? And for the bulls, it's a bull bar, a high 2, 6, and we have a magnet, the open of bar 1, and we're getting late in the hour. The bulls would like to get all the way back up there. That's probably too far to reach in 10 minutes, especially with a bad buy signal bar 10. But if you're a bear, let's say you sold the 10, let's say you sold the 9 close or below 9, you're disappointed at 10, and a lot of those bears are buying back their shorts 11, creating this rally. Trading range behavior. You get strong bars up and down, and they reverse instead of having good follow through. Bar 3 reverse, bar 4, 5 reverse, bar 7 reverse, bar 9 reverse. And traders are taking quick profits. So it's a good example. You don't want to be selling low, you don't want to be buying high, because we have a lot of trading range trading, and it's the exact opposite. It's easier so far for limit order traders to make money. They see a big bull bar 3, a big bull bar 4, they sell the close. Big bull bar 2, big bull bar 3, they sell the close. Big bear bar 4, big bear bar 5, they buy the close. Bull bar 7, they sell. bear bar 8, bear bar 9, they buy. So limit order market. Above bars, more sellers than buyers. Right? Stop order market. It goes above the high of the bar. You buy, expecting it to go higher. A limit order market. It goes above the high of a bar. You expect it not to go higher, so you sell. And the opposite, below bars. Stop order market. You sell below the bar, and you expect the market to go lower, begin a trend. A limit order market, you sell below the bar, and you expect that there'll be more buyers than sellers. So limit order market, traders buying below things, below 8, below 6, below 1, making money, and traders selling above things, above 2, above 6, making money. Still a bear channel. We still have a lower high 7 and a lower low 10. But this is all about the 60-minute chart. Can the bulls erase a lot of the bearishness of that first hour? Can they put a big tail on the bottom of the bar and make it less bearish? Can you buy above 11? It's fairly low in the day's range. I would not. It's probably too high. Also, you got to be thinking it's a limit order market. And if you're buying, you want to be buying low, probably with limit orders below things, below 1, below 6, and bear closes like 9, not with stop orders above. You can see the moving average going up quickly. It's a 20-bar average, so it's based on 20 bars. And now we have 11 bars up here. So of this average, 11 of the 20 bars are up here. So the market's getting pulled up here because the majority of the bars are up here. Bears trying to get, when they have a low one below 11, they're trying to get a bear bar 12 for another low one. They're hoping for a bear channel to continue. Bears low one 12. Looks like we're going to close near the low of the hour. Well, we're getting a lot of bull bars. 2 bull bars here, 2 bull bars here, 2 bull bars here. Low 111 on a bull bar. Probably buyers below 11, buyers below 10. Possible wedge. Remember I said when you have a big gap up, the bulls want to buy near the moving average. And they look for some kind of a wedge or for a double bottom. Here you can call it a lower low double bottom. Bulls, I would call it a wedge, but they need to get a reversal up. So 3 legs down, 1, 2, and possibly 3. For the bears, it's a bear channel, and they're hoping that we just keep going lower. It's important that 11 did not get above the 8 low. So that means the bulls who bought the 8 low were unable to make money. So that's good for the bears. Bar 12, the end of the hour, and you can see for the bears they have a bear bar closing on its low, so that's good for the bears. The bulls who are trying to get the hour to close back in the middle are giving up. 12 is a give up bar. How far down can we go? Well, we're right near the moving average. You can see early bear channel. Bears trying to get a breakout and a measured move down. Bulls hoping for a wedge. They'll need a bull bar on 13 or 14. And bears are trying to get a measured move down. They're trying to get 12 to close far below 10. And then they're hoping that we get a measured move down. I think that's probably unrealistic. Takes us down here. This is kind of a bar, bear surprise. People are selling the market. And what happens if we get a bull bar 13, wedge 6, 10? You would need a pretty good bull bar to make traders willing to buy above 13. Bears want follow through, right? They did not get follow through 9, 10, but they're hoping to get follow through here. Remember I said that the bulls would want a double bottom or a wedge bottom near the moving average. And wedge bottoms often do not look like wedges, especially on the open. You have to be very flexible about your opinion as to what a wedge is. Wedge, very tight bear channel. 4 bear bars, a lot of the bulls will wait for a second buy there. Others will wait for a bull bar closing near its high, moving a little bit below the moving average with a lot of strong selling, yet there's just a sell vacuum test of support. Wedge does not look like a wedge. It became a bigger wedge. So for the bulls, it's important. They need a bull bar closing on its high. Bears hoping to get follow through. They did not get good follow through after 4, 5, after 9. At a minimum, if we have a bear bar on 13, bears get out above 13. And if it's a pretty good bull bar, swing bulls will buy. Bears are hoping for the measure to move down. Well, we're at support. We're right near a 10% correction. Again, these prices are not accurate because of the rollover. So this could be 10 points away from where it really is. So I would not pay much attention to these lines. I'm leaving them in there so that once the CME updates its continuation charts, I will update these lines. For the bulls to buy 13, they'd like it to close on or near its high. A lot of times you'll get a very strong sell-off in a tight channel, yet you get a reversal up for the low of the day. Like that. Here we got a second buy. Does not look like a wedge, but we have 3 lows. Wedge near the moving average. 3 reversals up, 1, 2, and 3 near the moving average. A bunch of tails, a micro wedge. Does not look like a wedge at all. Does not look like a wedge at all. Got trading range open. So I would think of this as more a trading range open than a wedge. A failed breakout below a double bottom is a wedge because you have 3 lows, 1, 2 for the double bottom, and then 3. A bigger wedge. Tried to get a small one here. We got 1 more leg down. Let's say 13 closes on its high. Credible low of the day. But is it a scalp or a swing? It's a swing because he's buying in the tight bear channel, and therefore the probabilities are not as high as you want. If you want higher probability, you wait to see if we go sideways and get a micro double bottom, or you wait for 1 or 2 bull bars. Bears trying to get follow through. They're hoping that the gap below 10 stays open. They want 13 to be a breakout test and for the market to go down for a measured move. Bears, they'll stay short until we get a bull bar, maybe 13, and they'll get out above the bull bar 13. They don't have to. They can keep a stop above 11, but it's reasonable to get out above 13 because of a possible wedge. Can you buy at the moving average? Nope. So you're either selling or you're waiting for a bull bar to buy. I did sell early in 12, but I'm flat now. I'm not selling at the moving average, even though we have a potential measuring gap here. I thought it was important that 11 did not go above the 8 low. So we had limit order bulls 8 unable to get out on 11, and so they started to sell during 12. Remember, yesterday we had waves of selling around this price level. So, we sold off, 4 or 5 bars, 3 or 4 bars, relentless, persistent selling. That's very bearish. Instead of just selling it off for a bar or 2, we sold off for 3 or 4 bars. 4 bars. Climactic. Can you buy the close of 14? No, I would not be buying yet. Can we go below yesterday's low? Probably not. the gap up is too big. If the bears are that strong that they can create that kind of sustained selling, they would not have allowed the market to open way up here in the middle of yesterday's range. So today's probably going to remain an inside day, not go above yesterday's high, not go below yesterday's low. Are the bulls still looking for a wedge? No, they needed the wedge here on 13. We have another big bear breakout. Probably will go at least a little bit lower. Bulls hoping it's a parabolic wedge sell climax. 1, 2, 3. Well, I'm not planning to buy above 15. I'll wait for a micro double bottom. Above 15, I'll wait for a micro double bottom. Whenever you have that kind of extreme selling, usually you get a lot of stocks going down. And you can see ticks hit minus 1,000. That's usually not the final low in price. So this is probably not going to be the final low. For the bulls, the parabolic wedge, 3 strong legs down, 1 pause, 2 pause, 3. Bears, I get out of shorts above any bull bar, 15 for example. And for bulls to buy, I'm not sure that it's worth it. Buying above 15. Probably better to wait for a micro double bottom or wait to see if we get a couple bull bars before buying. I like parabolic wedges. I like parabolic wedges on the open. But when you have a lot of bear bars in a tight bear channel, that lowers the probability that the first reversal up will get very far. And when you have a very big buy signal bar, 15, the stop is far below. So at a minimum, you get out of shorts above a bull bar, 15. But to get long, I think the math is not all that good. Let's say you buy above 15, you put a stop below 14, you probably would. But what happens if it gets below 14, gets below 15? There probably will be buyers below. This sell-off is different from yesterday. Do you see the difference? Bear bar, bear, 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 right? Bear, 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 bear. So in terms of points, it's comparable to yesterday, but in terms of the appearance, it's not. We're not getting sustained selling. We're getting selling, pause, selling, pause, selling, pause. And that kind of hesitation usually happens if the sell-off is going to be part of a trading range, and it's less likely to last all day. So I'd get out of shorts above 15. And for the bulls, it's really difficult because the probability is not very good buying above 15. Now, for the bears, it's a low one, 15, but it's a bull bar, and we're right above the measured move target. So I bet there are buyers not far below 15. So I would not sell the low one below 15. Possible low of the day, I would get out of shorts for sure. But as far as getting long, parabolic wedge, moving average, if it's going to be the start of a swing up, we'll get more evidence of it. So I think better to wait for another bar or two before buying. Wait for another bar or two before buying. Do I still think today's going to be an inside day? Yes. Okay, so I don't think we're going up a lot lower. Best case for the bulls would be go up for a few bars and then go below 14 and reverse up a second time for a lower low double bottom, lower low major trend reversal, a second reversal up from the parabolic wedge. And for the bears, I think the bad follow through in the parabolic wedge will make a lot of bears wait for a couple legs up before thinking about selling again. Low one, possible parabolic wedge, and a series of sell climaxes with pauses after every big bear bar. So that usually leads to an exhaustion and a reversal. So I did not sell below the 16 doji bar. but I am willing to buy